The Philippine stock market is at very unattractive levels, which explains the general market weakness and low volumes. Let's discuss this in more detail. My name is Den Slim, and welcome to another episode of Monday Market Outlook. Some good news to start the week, as the Department of Finance clarified that instant noodles will not be included in the list of foods to be slapped with the salt tax. No? So this erased the 10% drawdown on URC and has consolidated at the 140 resistance zone. So this demonstrates the importance of making informed and rational decisions when trading. So because if you panicked and sold off on URC when it capitulated, especially based on a bill that hasn't passed yet, you would have missed out on this rebound. Right? So let's take a look at the breakdown of URC and Monde's revenues, which will not be affected. So most of URC's revenues are coming from snack foods and beverages, which comprises 85%. So only 15% of URC's business is on noodles. So their revenues may still be significantly affected if this bill comes to pass. So unlike Monde, whose noodle revenues are at 40%, when looking at companies to invest in, we have to consider the business environment that they're operating in. In this case, the outlook may not be as promising as before, and you can consider trimming down on URC given the uncertainty. How likely is this bill going to pass? Given the noodle situation out of the way, I think the odds have become significantly higher. Speaking of business outlook, unlike URC and Monde, our dark horse pick Bloom has a much better outlook. If you look at this chart, Chinese outbound tourism is projected to surpass pre-pandemic levels in early 2024. We are currently here at Q2 and we have a lot of growth potential in the coming quarters. This adds to our recommendation for non-index issues for future growth. Now, let's look at the Consumer Confidence Index. Both the 3-month and the 12-month forward-looking indices are now almost back to 2021 levels. I mean, this indicates that revenge spending may already be depleted. Household spending would most likely begin to slow down in the next quarter, as well as GDP growth would also slow down. In a recent report, BMI, which is a unit of Fitch Solutions, has projected a 5.9 GDP growth rate, which is a sharp decline from the 7.6% rate in 2022. Not only is this slowdown driven by lesser domestic demand, but it is also driven by lackluster global demand. And of course, the BSP monetary tightening is also having an effect. So last week, the BSP extended its policy pause that kept interest rates at 6.25. But recently, we have Eli Romolona, who has been appointed by President Marcos to replace Governor Medalla as the BSP governor. What would the new governor do? Would the new governor stick to the rate pause? Because remember that Chairman Powell has reiterated the Fed's intention to apply further rate hikes, which is driven by a stubbornly resilient labor market. This puts the target rate probability at 88% that the Fed will decide on a 25 basis points rate hike this coming July 26 at the Fed meeting. This Fed rate hike will most likely put pressure on the Philippine peso like it did last November. So if we look at the chart, we saw the dollar strengthen to 59.20 because the BSP was late to defend the peso. As the BSP started to aggressively hike rates during the last part of the year, we saw the peso stabilize at 55 before it weakened again to 55.26 as we did not mirror additional rate hikes from the Fed. Will we see a policy change from the new BSP governor? Now, let's look at the PSEi charts. The market was able to rally back into our critical zone but ended the week slightly below at 6,468. Now, the PSEi gapped up on Monday, rallied back to our critical zone, but met resistance at around 6,550. If you look carefully, the market hit the highs and rejected it thrice. So this is quite a strong resistance point. If you look at the downtrend line here, this also acts as a confluence of resistance at this level. As mentioned, low volume market tends to gravitate towards the path of least resistance. So we have to be open to the possibility that the market may suffer further weakness in the coming days. So this tracks perfectly into the scenario that we were expecting. And we'll see what happens next week. Let's just take a quick look at the non-index plays that we mentioned last week. So we have Bloomberry with a 6-day winning streak, no? And we have SSI as well, breaking through a couple of resistances. We are currently at 3 pesos, so congratulations if you were able to participate. Now, we still have Figaro Coffee consolidating here at 71 cents. So if you feel some FOMO, FCG would probably be a good bet. So let's go back to our PSEi chart and track our year-to-date performance. No, if we see, this was where we started in January, and we are currently at almost the same levels, a little bit below. The PSEi has posted almost zero gains since the start of the year and is actually negative 1.3%. Now, if you compare that to other countries, the Philippines lags behind most of our Asian neighbors. Now, why is this so? Our PE levels are currently at 12.1%, which is below our normal averages at 14.1. But if we compare our PE ratio with other Asian counterparts, we can see here that we are not expensive, yes, but we are also not cheap, right? And this is really about equity risk premiums. As we explained last week, equity risk premiums is the difference between the expected return of risk assets like stocks versus the expected return of non-risk assets like cash deposits or treasury bills. So if we look into the 10-year and 2-year treasury rates, it's at very attractive levels. We have 6.36 and 6.42. Historically, the PSEi has an annualized return of around 6.4 to 7.7%. I mean, hey, if you're putting your money on a risk-prone asset like stocks, yielding you 6%, 7%, and you have a risk-free alternative giving you 6.4%, I'd choose the safe asset, right? Which is why as treasury yields go up, the market tends to become unattractive to investors. As we can see here, as treasury rates go up, market goes down, treasury rates go down, market goes up, etc. Now, the market is currently going down. Look at what the 10-year treasury is doing. It's going up, right? So here we can clearly see the inverse relationship at work. A rough comparison of the PSEi versus other assets shows that stocks have become quite unattractive to investors. Like we have the PSE currently at negative 1.3%. While, if you invested your money at the start of the year on time deposits or treasury bills, you would have grown by 3% at this point, at this half of the year. As we recommended during our year-end report, you should consider high-yield bonds or time deposits because in a high-interest rate environment, they will become more attractive as time goes by. Even if you invested in A-REIT, right, you could have gotten better yields through the dividends it paid out. Not to mention that C-REIT's price almost went up by 12% this year on top of the 4.36 yield. So while analysts are confident that the BSP will keep rates at 6.25%, let's take a look at the next paragraph here. That's a big if. If the peso does not weaken substantially, like it did last year. So be careful when reading headlines as they might not tell you the whole story. So interest rates can still go up, which would make, equities again more unattractive, right? So I would recommend for you to have a good portion of your investments in time deposit or retail treasury bonds. Again, no yield less than 6%, please. Or a portion of your stock portfolio should be in a cash position to let you take advantage of non-index stocks that may show promise during the later half of the year. Okay, so let's move on to the global markets. Now, economic numbers came out last week, with consumer confidence numbers jumping to 109.7 to 102.5. Now, new home sales, again, very strong, 763 against the expected 675,000. GDP coming in hotter than expected, 2% as compared to 1.4. And initial jobless claims below expectations, 239,000 against 266,000. And, again, of course, this drove the markets even higher, as a lot of people are saying, the economy is so strong that we may not even have a recession anymore. So let's look at the S&P 500 charts. The S&P 500 rallied back to 4,450 after correcting for most part of last week. We were expecting the S&P 500 to consolidate in this critical level, but renewed AI hype kept the markets up and even broke through this resistance, putting it towards the path of its next resistance at 4,500 and maybe even 4,550. Now, this is typical of FOMO markets, as this big run-up here left a lot of FOMO traders in the dust. And usually, minor corrections like this gives them an opportunity to participate. If we look at some seasonality charts, July market performance has traditionally been very good, especially during pre-election years. Now, if you look at the green line representing the S&P 500, July tends to be a pretty good month, but for pre-election years, we tend to have a peak towards mid-July before some tapering happens during the last 2 weeks. We can see here that the Nasdaq has typically outperformed all indices. So if we are going to base the S&P 500's movement on the seasonality charts, we could potentially see a further move to the upside, to test 4,500 or even 4,550 before another correction during the later part of the month happens. Now, if it breaks through this, well, who knows? We could be in for another run towards 4,650 here. And, that would be exciting, At this stage, the markets can be quite unpredictable, and as we can see, despite many reasons to be negative, mega cap stocks has pushed the S&P 500 even higher. For the next half of the year, investors are starting to look into other sectors to begin pulling their weight, as the current rally was mainly driven by technology stocks. So let's look at the sector rotations, where we're seeing a rotation happening already in some of the defensive areas. So this will give the market something to fall back on when the tech sector stops going up. Whether or not this epic run continues is everyone's question. So next week, we head into a shortened trading week as the US celebrates, July 4th. We'll have a half-day trading on Monday and no trading day on Tuesday. So, that's it for this week. I hope you found this episode useful. Please like this video, subscribe to the channel, and I'll see you again next week. Bye-bye.